The market is currently closed. As of the last trading session on Friday, January 2, 2026, Plug Power NASDAQ PLUG closed at $2.23, marking a significant intraday gain of $0.26 or 13.25% for the day. This explosive move to start the year has caught many retail traders on the Robinhood app by surprise, especially those who had written off the hydrogen pioneer as a lost cause after a brutal previous year. While most of the attention in the broad market recently has stayed on Apple stock or the latest volatility in Nvidia stock, this double-digit jump in a low-priced ticker like Plug Power signals that something is shifting beneath the surface of the green energy sector. If you've been following the narrative around this company, you know the common expectation. The prevailing belief is that Plug Power is a sinking ship, a business that burns through cash at an unsustainable rate and is currently facing a massive legal investigation that could threaten its very existence. However, the reality we are seeing in the data is far more nuanced. While the market was obsessing over the risks of a federal loan guarantee being pulled, the company was quietly hitting record production levels at its Georgia facility. In August alone, they produced over 324 metric tons of green hydrogen with an uptime of 97%. This is not a pilot program or a theoretical experiment. This is industrial-scale production that is actually working. The gap between the failing company narrative and the operational success data is exactly why we are seeing such a violent move in the stock price today. When you look at your individual brokerage or check your holdings on the Fidelity mobile app, it is easy to get distracted by the big names, but the action in Plug Power suggests a massive repositioning by institutional players who are looking for value outside of the typical tech giants. The company recently announced it would seek to double its authorized shares from 1.5 billion to 3 billion. In any other context, that kind of dilution would be a death knell for a stock. But in this case, the market is interpreting it as a necessary step to provide the liquidity required to reach their 2026 break-even targets. It's a gamble on survival, and today's 13% jump shows that some big players are betting they will make it across the finish line. If you are using tools like Schwab Intelligent Portfolios or other online investment platforms, you might notice that green energy often carries a higher risk profile in your diversified buckets. But for those engaged in self-investing, the recent movement in Plug Power is a masterclass in how sentiment can lag behind operational reality. While the headline news was focused on the Department of Energy pausing its commitments, the company was busy signing letters of intent to provide fuel cell backup power for data centers. This is the same market that has driven the massive gains in Nvidia stock, but applied to the infrastructure side of the house. Data centers need massive amounts of reliable, clean energy, and Plug Power is positioning its PEM electrolyzers as the answer. Let's look at the recent trading volume. We saw over 94 million shares change hands in the last session, which is a massive spike compared to the 3-month average. This kind of volume usually indicates institutional activity. If you look at your SoFi Invest account or the Interactive Brokers platform, the technical setup here is screaming short squeeze. With a short interest that has hovered around 30% of the float, any bit of positive news, like the record production in Georgia or the $275 million liquidity injection from asset monetization, forces the bears to cover their positions. This creates a feedback loop where the price keeps climbing, not necessarily because the fundamentals have fully healed, but because the cost of betting against the company has become too high. Despite the optimism today, we have to acknowledge the pressure. The company is under investigation for potential claims on behalf of purchasers who feel misled about the status of those federal loans. This is the tension that keeps the stock at $2.23 instead of $22.30. Investors using investing sites or seeking investment help are often told to stay away from stocks under legal clouds, and for good reason. The reality is that Plug Power has a path to profitability, but it is a narrow one. They need to prove that they can operate without the massive government safety net they once relied on. By selling non-core assets and monetizing electricity rights in New York, they are effectively telling the market they can stand on their own 2 feet. Many people compare the volatility here to what we've seen with Tesla stock in its early years. There is a core group of believers who think hydrogen is the only way to decarbonize heavy industry and logistics, and then there are the skeptics who think the technology is too expensive and the infrastructure too thin. If you were doing online investing through a Fidelity brokerage or a Robinhood stock trading account, you are likely seeing these two worlds collide every day in the comment sections. The Project Quantum Leap initiative is the company's internal attempt to bridge this gap. It's a program designed to make the operations leaner and more efficient, cutting the cash burn by over 50% in the last quarter alone. When we talk about the business model, we have to go back to the basics. Plug Power isn't just making fuel cells for forklifts anymore, though that remains a core part of their revenue through partnerships with companies like Amazon and Walmart. They are building a vertically integrated hydrogen ecosystem. They make the electrolyzers that create the hydrogen, they operate the plants that liquefy it, and they provide the fuel cells that turn it back into electricity. It's an ambitious, capital-intensive model. This is why you see so many different takes on investment forums and Fidelity Mutual Funds reports. Some see a future titan, others see a company that has bitten off more than it can chew. The shift into the data center market is perhaps the most interesting development of the last few months. As AI continues to expand, the power grid is under massive strain. Companies are looking for off-grid solutions that can provide multi-megawatt backup power. Plug Power's recent move to collaborate with U.S. data center developers suggests they are pivoting towards a market with much higher margins than traditional material handling. If they can successfully deploy their 5-megawatt electrolyzers in these environments, it changes the entire valuation thesis of the stock. It moves them from a green energy experiment to a critical infrastructure provider. This is why if you check your SoFi active investing dashboard, you might see a sudden uptick in sentiment despite the historical losses. For those of you managing your own portfolios, whether through Fidelity Wealth Management or a simple individual brokerage, the question always comes down to the risk-to-reward ratio. At $2.23, the market is pricing Plug Power as if it is on the verge of bankruptcy, yet the company is still delivering hardware to projects in France, Portugal, and Namibia. They just installed a 5-megawatt system for Africa's first fully integrated green hydrogen facility. There is a clear disconnect between the global demand for their technology and the valuation the Nasdaq is currently giving them. This is the curiosity loop that keeps investors engaged. If the company hits its goal of being EBITDA positive by the second half of 2026, the current price will look like a historical anomaly. Comment below how many shares of Plug Power you currently hold, or if you think the shift into data center power is enough to save the company from its debt load. Driving engagement on these topics is crucial because it helps reveal the sentiment of the retail crowd versus the institutional smart money. We see a lot of chatter on the Robinhood app and SoFi trading platform, but the real test will be the special meeting on January 29th. If shareholders approve the increase in authorized shares, it gives the company the oxygen it needs to survive through 2026. If they vote it down, management will be forced to look at a reverse stock price just to stay listed on the exchange. If you are using Interactive Brokers trading or checking the Fidelity trading platform, you can see that the bid-ask spreads on Plug have been tightening, which often precedes a larger trend. The macroeconomic pressure of high interest rates has been the biggest headwind for green energy stocks over the last 2 years. As the Federal Reserve signals a potential shift in policy, capital-intensive businesses like Plug Power become much more attractive to investors who were previously parked in the safety of cash or big-cap tech like Apple stock. The cost of financing those hydrogen plants in Texas and New York becomes manageable again, and the path to a positive return on investment becomes clearer. We should also touch on the competitive landscape. Plug Power isn't the only player in the field, but they are the most integrated. While other companies might just sell a component, Plug is selling the fuel and the service. This is a high-stakes strategy that requires massive scale to work. If you were looking at investing sites for investment help, you'll often see comparisons to other hydrogen stocks that have much cleaner balance sheets but significantly less revenue and market presence. The reality is that Plug Power is the incumbent of a new industry. They have the 72,000 fuel cell systems already deployed. They have the 270 fueling stations. That footprint is a massive moat, even if it has been expensive to build. Looking toward the future, the catalysts for 2026 are well defined. We are looking for the final investment decisions on several multi-gigawatt projects in Europe and Australia. We are looking for the official commissioning of the South Korean gigafactory with SK Group, and most importantly, we are looking for that first quarter of gross margin break-even. If they hit those milestones, the tension between the expectation of failure and the reality of a functioning business will finally break in